In a lot of the large transactions going on in the senior care market, REITs are making a lot of the headlines. But there are other finance companies who are fully capable of doing very large transactions. I'm sitting here with Jim Seymour. He's a Senior Managing Director of GE Capital's Healthcare Financial Services Group. And Jim, it looks like 2012 is going to be end up being a great year for you all. Before the year's over, you already had $1 billion in financing. You're probably going to do more. I know you did a large $445 million deal for Tandem Health skilled nursing portfolio. Did you have any other large skilled nursing or senior housing deals in that portfolio so far? I mean, in your year-to-date numbers.
The as you said, we've done about over $900 million when we issued our kind of pre-NIC press release. We'll probably end up just over double that for the year, and certainly there'll be some big transactions in that number. The way that breaks out, we've been running at the last 2 years about $1.5 billion to $2 billion a year in financings, although over kind of the 40 to 50 transactions a year range. So there'll be 3 or 4 big deals in that number, and then the most will be kind of in that $20 to $50 million range. But the Tandem transaction is one we announced. We included. We don't talk about specific customers unless we have their permission. But there's another $200 million senior housing deal in there where we held about $120 million. There's another refinance of a senior housing deal in about the $135 million range, and the rest would be kind of flow transactions more in that $15 to $20 to $50 million range.
But what attracted you to the Tandem portfolio for such a large loan in their recapitalization? What'd you like about them?
Well, the large transactions have been a big part of the heritage, of GE Capital as a finance company. We get comfortable with the large transactions based on a few metrics. One is that we like the bigger deals. We even get comfortable with bigger holds in the bigger deals because we get a spread of risk. So we get multiple properties across multiple states where we feel like we have a diversified exposure. That's one. Two, we're only going to do large transactions with owners and investors of real estate who have a successful track record of investing, who we know are going to reinvest in their properties. And certainly in this case, that's the case, with the owner of the Tandem business. And then also, we need to be comfortable with the operator, right? That in terms of how they manage their business and how they adapt to change and the reimbursement front, et cetera. So really, we had all of those in the Tandem transaction. And then lastly, whereas in the past we do a $400 million deal, we would have held the whole $400 million. To do large deals like that today, we look at transactions that we can bring in some partners and syndicate some of the risk, and that was certainly the case there as well. Mm-hmm. We held slightly less than half of that loan, and we have 3 or 4 other financial institutions in that loan with us. Okay.
And are you looking at to do any other large skilled nursing portfolios in that sector as opposed to senior housing?
It's interesting. We said last year at this time we were going to be very selective, in the SNF space as we waited for the RUGs 4 rollback to work its way through, and I think that's been the case. We haven't seen as many skilled financing opportunities this year. I don't know that there's been as many M&A transactions, at least at the size level that we normally play in this year. So I think the answer is we haven't done, at least in terms of number. That's obviously a big deal, so even if we do $2 billion of financing this year, it'll be a significant percentage. But in terms of numbers of deals, we've done fewer SNF deals than we have in the past, but I think that has less to do with our appetite for the space and more to do with we haven't seen as many. We haven't seen as many transactions. I think particularly early in the year when we were kind of in those first few quarters of post-RUGs 4 rollback, there was a significant bid-ask between sellers willing to sell at and buyers willing to buy at. I expect we'll see more volume as the year goes through. But no, that's the only big SNF deal this year.
And some lenders are kind of taking a step back, obviously with the economy, with the election. They're worried about Medicare and Medicaid risk. How do you, especially with large transactions, how do you, you can't really financially hedge against it, but how do you deal with that risk and underwrite that risk?
We're comfortable underwriting. We have one of the nice things about having a large group of people focused on healthcare, not just in real estate, but in healthcare lending, is we can make some investments to really understand those risks. And we have what we call our investment research group, and we have a device expert, we have a farm expert, and we have a gentleman who is a senior housing and care expert. And his job really is to understand Medicare at the federal level, Medicaid at the state level, and we build that into our underwriting for every single transaction. So we'll have an expected case we'll have downside scenarios off that. To give you an example, when the initial RUGS 4 was implemented, a couple years back, we didn't believe it was permanent. When we saw what it was going to do, and we didn't underwrite to that benefit. So as a result, we really didn't have a lot of stress in our portfolio as a result of it because we never built it in the first place. Right. And so look, we pay a lot of attention to it, and we build it into our projections. I think that was part of the problem earlier in the year, was because it was going to be, the impact was going to vary by operator. It was very hard for lenders to look at cash flow and underwrite because you had trailing data that were on an old set of rules, right? So I think now there's been 3 or 4 quarters of data with the new rules. I think you'll start to see lenders get a lot more comfortable with what operators are doing.
Now, I know you do a lot in the skilled nursing side. Are you trying to grow your assisted living, independent living, senior housing, private pay portfolio?
Well, as if you take a look at the volume that we're going to do this year, because there's fewer skilled deals, it does mean we are doing quite a bit in the senior housing space. It's actually good to be here and listen to what other folks are saying about what they see in the M&A markets, et cetera. But absolutely, I think the private pay, the IL and the AL and the memory care is absolutely a huge part of what we're doing. And in terms of numbers of transactions this year, it will dwarf the number of skilled transactions that we do.
Oh, well, yeah. That's kind of a change. It seems from the past.
Our volume in the past has been relatively evenly split between the two. If you look at us over the last couple of years, and we had a couple of very big positions in skilled nursing, which were refinanced in 2011. So our skilled book, as a percentage of our total, is smaller now than it's been in a decade.
Mm-hmm. And as a lot of people know, and going back 10 years. GE was always kind of known as one of the few go-to firms if you needed a $500 million loan, $1 billion loan. Not as many of those out there. So you've seen a lot. And I know it's you prefer sometimes it's easier to do the big ones, right. But that 20 to 40, 50 million loan size. Are you tapping into that a lot?
A couple things in that. On the larger deals, we absolutely still like to do those transactions. I think one of the things going on today is with the tremendous amount of REIT activity, a lot of those larger deals don't need third-party financing, right? So, but in the ones that are there, we're very aggressive on them. We like to do them. Like I said, the big difference is we don't hold 100% of those loans anymore. We'll hold anywhere between a third, to 40% of those loans. But with less of the larger deals, being available, we absolutely are spending a lot more time and energy focusing on, on what I call the mid-sized deal. We're never going to be the right borrower, for one SNF, in a rural location. But for smaller portfolios, as small as $10, $12 million up to $50 million, we're trying to be much more competitive in that space so that we can have a much broader presence in the market space. Right. And we're having some by the numbers of transactions. For example, we may do round numbers. I'm not going to project, but say it's around $2 billion of volume this year. That might be similar to what we did in our best years, before the economic crisis, where that might have been 12 or 15 transactions in a year. That'll be more like 40 or 50 transactions for us today.
Any forecast for 2013? What you think your volume will be?
I would be very happy if we could have a year very similar to this year. I think, look, we're trying to grow the debt business, and I'm sure I will be handed a target for next year that looks an awful lot like we have now. Somewhere in that $2 billion range, $1.5 billion to $2 billion.
That's certainly what I'd say is an industry leader. So that's out there. Well, thanks for sitting down with me and catching up with what you're doing.
Thank you very much, Steve.
All right, take care.
My pleasure.